soon as we start a flow show, in the middle of a flow show, someone drops some big comments. So just want to make sure I cover this item first. We've got UK's Truss and Chancellor Kwarteng apparently meeting the OBR, and the market's getting itself in a little bit of a tizzy about what that might mean. So for those that don't know, the OBR is called the Office of Budget Responsibility. They are supposedly the independent bean counters for government policy, government fiscal measures, the Treasury, that sort of thing. So anytime the government wants to cut taxes, do anything fiscally, plans, debt borrowing, you name it, these are the guys who supposedly then go and write the forecast and cost it all out and say what it means for the economy and what it means for how much it's going to cost the country and the Treasury. Now, given everything that's gone on this week, the market, as I say, is making quite a bit out of this. I think it's probably a big reason why the pound is up as high as it is again today, because the market may be thinking that, and it's been titled an emergency meeting between Truss and the OBR, and I think the market may be thinking that the OBR are going to rein in Truss and rein in Kwarteng's plans in terms of how much it's going to cost them, cause them to scale down their plans perhaps, and bring things more manageable. Now, that is a possibility that happens. It's more likely the other way around, where Truss and Kwarteng are going to try and convince the OBR why their plans are sound. So the comments that come from this could be a further boost to sterling if the OBR turns around and says, yep, it's going to cost a lot, but it's manageable. Or on the opposite side, the OBR convince Truss and Kwarteng to scale down some of their plans. What's going to be negative for the pound is if we get none of that, and the OBR say, you know, what you're doing is going to harm the UK, and Truss and Kwarteng say, well, stuff you, that's what we're doing anyway. That's the negative side. But you need to know the OBR are probably one of the most useless at forecasting or getting their forecast right in terms of UK economics and counting the beans. I don't know a single time they've been right on any one of their forecasts. They are always very pessimistic, and as that may be their remit, it's their job to look at the risks or to look at the worst case scenarios. But they are very glass half empty, but you need to know that in terms of the greater context of what these clowns are. I always call them the Office of Bodged Responsibility, because they are that useless. But
tell us what you really think about them.
I'm keeping it clean for now.
You're not wrong, by the way. You're not wrong.
But yeah, you know this from your time in the UK. But they are who the market listens to, because they are the only authority that do this sort of thing that's recognised by the government. So I just wanted to bring that to you, so you know if these headlines drop from this meeting. I'm not sure when it's going to happen. You've got a good grasp of how to analyse the headlines and whether it means it's good or bad for the pound. So anyway, just wanted to drop that in there before we start. Right, into the rest of the other news. Now, we'll stick with the UK because BOE's Peel was out yesterday again with some comments saying that the BOE action, and this is the gilt action, was not a monetary policy operation. So confirming what I was saying yesterday, that these measures, this gilt buying, is targeted at a specific, let's call it a specific leak in the pipe. Okay, this is the Bank of England sticking their finger in a leak that's developed, a problem that's developed. It's not supporting the whole market. It's not there designed to support the whole economy. It's addressing a certain problem in a certain area, and that's what Peel's confirming there. But then he's also moved on to the fiscal talk, and he said that it's hard to avoid the conclusion that the fiscal easing announced will prompt significant and necessary policy response. In my opinion, that's him touting that the Bank of England are going to act, and one of the big reasons they're going to act at the next meeting in November, obviously to hike rates, is down to this fiscal plans from the government. So that potentially opened up the door for a bigger hike than what's expected. The market was already skirting around 75s. Now we've got the 100 basis point calls up again. But that's a little heads up he's given, saying that that's potentially what's going to happen in November. Now, going to the Bank of England operation, the gilt operation, and to remind you that they're buying only maturities over 20 years. So that's effectively 30-year bonds. So it is, as I say, very targeted. They bought 1.41 billion out of the 5 billion daily limit they've given themselves. That's up from the 1.02 billion yesterday. So we're still not close to their limit, which again suggests that things aren't as bad as many perhaps have been making out. It's probably going to take a few days for this to all settle itself down, but we'll keep an eye on these numbers and see what's happening there. So that's that from the UK side. Over to the ECB. ECB's Lane was out yesterday as well. They will hike over several months, not a few weeks, he said. The discussion is the size of the October hikes 4 weeks out is not helpful. And he also said that the FX rate channel is not significant enough to influence monetary policy. So a little bit of a comment on FX moves in those terms. Now, back to his first comment that they will hike over several months and not a few weeks. And I was reminded actually by our resident Italian Five Magics in the chat room of the comment Lagarde made at the last ECB presser, where she said hikes will happen over more than 2 meetings, but not as many as 5 or something along those lines. So as we were doing yesterday, putting the hikes and the potential where rates can go over how many meetings are coming up. Locked one off for that last meeting because it included that last meeting. So we're looking at maybe 2 to 4 hikes or 2 to 4 more meetings where they're going to hike. So again, it's giving us a rough idea of potentially where rates are going to settle. Guys, you got anything on you want to add into that UK stuff and ECB stuff?
Not really. Did you mention it? We got the Eurozone CPI.
Yeah, I'm going to go through
You're going to go through that? Yeah, okay. No, I don't have anything else to add, no.
Okay, cool. Thanks for that. Okay.
Yeah, well, it seems a lot has to do with those BlackRock rumors and the FinTwit's fear got onto that, saying that the UK pension fund market was on the verge of collapsing, and apparently it's all come from these BlackRock saying that they might hold some of their clients, what is it, LDIs or whatever the rebalancing needs that they had and stuff. And I think together with what's happening for month end and quarter end, perhaps this has completely reversed the sterling over the past 24 hours. No, I think perhaps, yeah, you're right. Things are not as bad as they seem. But then, as I also mentioned, I think on F.A.C.E. it may also be that just the pension funds are now seeing down to where the BOA can quiet down the markets and then come back into the market and do whatever hedging they need to do. So, as you say, a couple of days to wait and see what happens next week. They are in it for 2 weeks. So people are doing their calculations, and then I think next week will be relatively interesting to see what happens then.
Yeah, definitely. And for the record, again, I'm not saying this is the end of everything that's going on in the UK. There's not going to be issues, further problems, further leaks springing up in the pipe from other areas. Not in the slightest. But what I think we've seen this week, particularly from the UK press, is tantamount to extremism in their use of the information they have, or lack of information they have or used in what they've been peddling this week. It's been far too extreme. I mean, there's even people saying, they're doing comparisons. If UK mortgage rates go up 2%, 200 basis points, mortgages are going to go up, 50, 70%. If rates are running at mortgage rates are running at 5%. The US just recorded 6.7% or a bit higher in mortgage rates. No one's shouting and screaming about how much it's costing US homeowners or mortgages in extra money. So it's a bit of blinkered thinking from the UK and a lot of commentators. And I think when it gets that extreme, you're going to hear me fighting against it, because it's not good for you guys. It's not good for me. It's not good for trading if you get sucked into that extremist narratives from the press and commentators. You've always got to look into it yourself, be objective, and see what is actually happening, because that can affect your trading. Plus, it gives you opportunities. If the market is getting extremely fearful and it's not justified, well, you've got a reason to then fade that fear. And fading fear is often a very good trade sometimes. But I digress. Moving on. But that BlackRock thing was hilarious. These guys are supposed to be, one of the biggest, hugest in the industry, and they're getting their knickers in a twist over a bit of volatility in UK gilts. I mean, you've got to think, if you had your money with BlackRock, would you trust them after that and saying that sort of thing? But anyway, let's move on before I get into a real rant. Over to the US, and Fed's Daily said that rates are at neutral as far as she's concerned. Rates are in that 3%, 3.25% mark at the moment. That's where she sees the neutral rate. But she's comfortable with rates carrying on up to the 4.5 to 5% range for 2023. So again, we're getting a bit more on the numbers of where Fed members see the peaking rates and where they see them potentially coming back to. And that, again, the market is factoring all that in. As far as the dollar goes, we are not seeing new highs in the dollar. We've not seen new highs in yields outside of what we saw beginning of the week. So the market is probably getting to grips with where the Fed are at now. And it's going to take yet more hawkish news, higher inflation, higher prices, higher this, higher that, to get the market getting even more hawkish and pricing higher. Now, I've said at the beginning of this week, I think we're getting to the point where we're going to see a top in the dollar or yields, because I can't see where any more hawkish news is going to come from right now. We may not be at a peak in inflation, but we could see it moderating from here. So the comments from the Fed members are pretty much in line with that, and the market, I think, is getting in line with that in terms of pricing where the Fed's at. Right, over to China, and we know we had, let's get rid of that for a second and get the charts up. Let's start looking at that. We know we had yesterday's beginning of the flow show, we had that story from the PBOC telling banks, apparently, I don't think it's been confirmed yet, to stock up ahead of potential intervention. That's got us a very big move in the yuan, which, as you would have seen yesterday, myself and the K-Man traded right as we were in the show. Now, this move has gone quite far, probably further than even I would have thought. But we've had another comment out today from the FX body asking banks to trade yuan around the fixes. Now, we've been watching the fixes on and off. At times, they can be an indicator of what China wants to do with the rate. At other times, it's just playing catch up to the market moves. Now it becomes in focus again, because if China's asking their banks to trade around the fixes, where the fixes get set is going to be important for where the rate rides. So we had fixes around 7.10, 7.11, while the price was trading all the way up in 7.20s. That might not be the case now. The rate might now stay closer to the fixes, which means any moves higher are likely to be sold into to bring that level down towards those fixed numbers. So this is important for trading the yuan. If you're trading the yuan, what China says goes. You've always got to listen to them, and there's not that many central banks that will give you as clear a heads up in how their currency is going to move as these guys are. What did you make of that, Kay? The latest news from China, and,
yeah, well,
this move in the yuan, it's fairly big, isn't it?
Yeah, because all those rumors are pseudo announcements when it comes from them, right? They're sending out their submarines and giving the rumors to the press, and then the press, of course, is tasked to spread those so-called rumors, which are actually merely telling the people that that is what they are going to do. So yeah, they want to keep it in a band. They don't want to. I think they saw, and I mentioned it already a couple of times before. You can do CNH, and CNH is just the non-local yuan. You can do it, and you can stretch it until a certain point with speculative flows. And as we have seen, and as I mentioned already a couple of times, we were like outside of the 1.5, at least even 2% at one stage, above their fixing rate, which they really don't like. So they are also a little like the MOF in Japan, trying to kill speculation a bit. But to me, it still doesn't mean that they are going to put dollar yuan back below 7. I think 7 is actually going to be some sort of a bottom. That is my personal idea. But yeah, I think they just want to quiet down the speculation for now, because on the other side, PBOC have done their biggest injections of liquidity this week. So do what I say, but don't do what I do. That's a bit the same thing as in Japan, really. And Bank of Japan is pressing on the easing pedal, where the MOF is saying, well, don't sell the yen. So it's a bit the same thing, in my opinion. And then the yen will probably be a pretty decent blueprint of what will happen to the yuan in terms of trading. I'm not saying in terms of like commerce or involvement or how shall I say, managing of reserves or so. But China is now on the trading basis exactly the same. They are easing, but at the same time they are telling us not to sell the yuan, and they can intervene whenever they like. $3 trillion or a bit less, they can stop the market wherever they like. So yeah, in my opinion, it's exactly the same as in Japan. They are calming the markets.
Yeah, and the PBOC are the biggest central bank in the world. If they want to do something, don't worry about what reserves they've got, what powers they've got. They will do it, and no one shall stand in their way. But a couple of things to also bear in mind, and we touched on it this week. They have got their People's Party Congress coming up, which is a big deal in that. We already heard that they've instructed, or allegedly instructed, banks to buy stocks, to give a good impression when they go into this People's Congress. Also, next week is Golden Week, so they're off all next week. But they'll still be watching the markets. And as Kay rightly said, they're not going to likely look to send the price to any particular level. They're just taking a bit of the heat out of the market. That doesn't mean we don't see dollar yuan rising back up again. But it means that they potentially got a tighter leash on it. So we may not see the moves up as high to the 20s or something like that than we've seen previously. But holiday there next week for China, and this party congress coming up as well. Right, before we go and take a look at the data, because there's been quite a bit out there. The other bit of news was Riksbank's Floden said that rate hikes are not set in stone, but they may hike by 50 basis points in November, but there could be more or there could be less. So not going out on a limb, but keeping the message and hikes in place there, but not set in stone. Right, so let's have a quick look at the data, because there was a fair bit out. Yesterday, jobless claims still looking pretty good. Just look at that 4-week average. Where's it gone? There, lower again. So the Fed aren't yet seeing any real signs of the labour market going the other way. That would suggest that next week's NFP potentially is going to show, I would say, positive numbers, whether they're a big positive, a little positive, or whatever. But there's no indications, and it's still a lottery, of course, the NFP. There's no real indications coming from anywhere that employment is going to be getting crunched anytime soon, but that's for next week. GDP, final GDP was confirmed in recession, minus 0.6 there. Today's data, quite a bit out from around the globe. Let's get the page up. A ton of data from Japan, better unemployment rate there, better industrial production numbers there. Forecasts were a little bit lower for the next month ahead, but for a couple of months ahead, higher. Retail sales as well. Larger retail sales up 1.4%. Retail sales year on year up 4.1%. Again, in the year on year numbers, maybe a little bit skewy because of prior lockdowns from the virus, etc. But again, another run of good numbers. Construction orders year on year up 17.9%. Again, the same caveat there. Household confidence took a little bit of a knock though, down to 30.8 from 30.2. So not all going one way for Japan. Household confidence obviously is a big marker. Housing starts up 4.6% from minus 4.1 expected. So a big switch around there. Again, the caveat stand. UK GDP, a bit of a surprise here. Coming in for the final reader up 0.2% versus the prior estimates, prior readings of minus 0.1. So we've avoided dropping into negative territory in GDP with that 0.2 print. Okay, nothing to get the bunting and jelly and ice cream out over, but the optics, you know, US is now in recession, other countries heading for recession. The UK is not quite there yet. So that would have confounded a lot of the UK press who have been predicting doom and gloom for the UK. Now we get some CPI numbers as well from the Eurozone. France, a little bit of a dip in CPI there. The Eurozone measure down to 6.2 from 6.6 prior, missing the estimates of a pip higher at 6.7%. CPI, pretty much the same thing, was expected to come in unchanged, dropped to 5.6%. Germany, the unemployment change, up 14K, so no big deals there. The unemployment rate staying steady at 5.5%. There has been a bit of a skew coming into the German unemployment numbers because of people being displaced from the Ukraine, going to Germany, and then going on to the jobless list or looking for jobs, going into the jobs market there, has skewed the numbers there slightly. Then we got some lending data, mortgage data from the UK. Strong read in mortgage approval, 74,000 versus 62 expected and up from 63, call it 64K last month. Mortgage lending there, a big jump, 6.14 billion. What does that mean? That means that we've likely seen a lot of people in the UK getting their mortgages done fast, booking it in quickly, locking in those deals as rates are going up. Now, this is obviously older data. This is all come before what's happened this week, where we've heard that mortgage firms are pulling mortgages because of the uncertainty with rates. But the process looks like it started earlier, where people are locking in those mortgages, getting their house deals done, which is no bad thing if people are getting fixed rates ahead of rates set to rise higher. It means they've got their finances protected. They know what they'll be paying for maybe 2-5 years, as you can lock in mortgages for that sort of period. Italy inflation there as well, up near 9%, 8.9% on their measure, 9.5% on the Eurozone measure. No change there from inflationary pressures in Italy. Greek PPI numbers there, again, prices higher. The theme of the day. Eurozone overall, the pan-Eurozone CPI measure hit the 10% mark from 9.7 expected and 9.1 prior. Now, as this is the pan-Eurozone number, there's probably a big influence, a big weighting in there from Germany, and what we saw yesterday with those big rises. Those rises were mainly due to the government transport subsidies coming out of the market or out the prices in September, hence why they got a big jump there. So that number may be a bit influenced by those German numbers, but still, when the ECB look at those numbers, they're just going to see high inflation, and the core number. Why is the core number not there? Where am I doing it? That was up at 4.7% versus 4.8% versus 4.3% price. So that all important core number, well above the ECB's 2% target and showing no signs of slowing. Right, let me check my list. I think that's everything covered there. Oh, one last thing. A little headline that went through yesterday from a Russia foreign minister spokesman or spokeswoman, saying that the Russia and US are considering in-person meeting on starting new nuclear arms treaty. That went through the market maybe a little bit under the radar, but that is a potential sign that maybe there's going to be some talking between the US and Russia. One of Russia's problems is their worries about the West parking nukes all around Europe, including the US and other missile systems and whatnot. And they've been very much against what the old nuclear deals were in place. So if we get something like this, it's going to be a big boom for risk if that's confirmed. And of course, if anything positive comes up from it, that also may lead to reduced tensions with the Ukraine. Because again, that's one of the reasons why Russia is invading the Ukraine, is to push their lines further towards the West, and obviously not allow Ukraine to be one of the stations where the West can park up armaments and things like that. So just one thing to watch out for if that develops further. Phew, that was a lot today. You guys, you got anything you want to add to that before we get into the charts?
You said it all, man. Seriously.
I'm going to need to get a couple more pads when I've up to about 3 pages now in notes in these mornings. So, but that's you know, that's what we look at. These lines and these headlines, they can be market moving. You know, that's why we look at these things. That's why we concentrate a bit more on the fundamentals on this show, because it's what drives the markets. It's one thing being just a technical trader, but it's the fundamentals that move the prices up, over, through to at your technical levels. Hence why they're so important. Kay, you got anything you want to add to that before we?
I'll talk about the Central Bank of Mexico when I show the chart.
Yeah, well, do you want to get into that for a bit and then?
Well, yeah, if you want to, I can. Let me just get to the right page first.
Yeah, right.
Right.
Yeah, Angela was looking at. She's trading US indices at the moment, so we can have a look at that. No problem.
Yeah, I can do the S&P, and then if you want to look at the others, be my guest.
Oh, thanks for that, Kevin. Kevin just said the OBR chairman will be putting out a statement later today after meeting with trusts.
Yeah. Just seen it. They can't hold back from saying something while we are doing the flow show. I think those people. What's wrong with those people? Leave us alone.
Well, I'm glad they're watching the show that they feel they need to intervene, mate.
Oh yeah, that's why they wait to put out the statement, because we are on the show. Thanks, guys. I mean, what's his name? Hughes? Gotta send him a Christmas card. All right. Central Bank of Mexico, they raised the rates up to 9.25%, and we've had a pretty violent reaction on the back of. Why is my chart so bizarre? Okay, we had a pretty good reaction. Basically, what Mexico is doing is mimicking what the Fed is doing, really. So that explains in a way, even though due to the strength of the dollar lately, we had this push higher in the dollar mix in sympathy with all the rest of the other dollars. But then we've seen already the day before yesterday it's starting to come off again when the end of month and of quarter started to kick in, and then yesterday we had a bit of a move lower again, and now we're coming to rest here. It's a bit of an interesting zone, in my opinion, somewhere around this 2003 to 2008. Watch that for the end of the week, and especially going into next week. I would say there's a lot of flow still to be done. until 4 p.m. or even later today on for the end of month and end of quarter. So still anything can happen. But keep an eye on this one in the dollar mix. The other one, which I am, of course, much more involved in over the past months and even longer, is the euro mix, and we've gone through this first little resistance. That was around 1966. We went up to the 1980s. Sorry, I'm quite interested in this little zone here now to get a bit deeper into it. I still think the reason for that is that, okay, this, first of all, there's a very big differential in interest rates between the euro and the MEX. And as I was saying as well, we could argue on the yen as well, but then they are trying to intervene. So I don't know whether it's, for the long term, it may still be a good trade, but in the short run, I'm still more interested in this euro. I'm going to have a look at where they can put it for the end of month quarter, but anywhere in this 1990-20 zone, I'll get very interested. Unless we can't even hold this and we're starting to break below here, then next month there's a possibility, in my opinion, that we are going to trade the next leg lower. We're down to low 19s, and why not even into the 18s? But that's more of a longer term project, but it's still one that I'm very interested in. Take a look at what's happening in the metals. Gold finally broken above this 1950s again. I'm still, as I've been saying already a couple of times, I'm still in end of month quarter mode. I don't know what's going to happen come Monday, but in the meantime, for those day trading, if we get up to 1680, 85, that's where we broke down the other day. That's where we capped, and I think that's going to be a very interesting zone to watch right here and now. And on the other side, I'd say 40, 43, 49 on the day. I think we should be our range if normality is respected. But again, anything is possible. End of month, end of quarter. I think we're seeing similar things in the silver. Unfortunately, I did not, apart from my long-term longs, I didn't add or on this time around the 18 level, but the rejection is pretty clear every time we go under there for now. So I'm going to watch this zone to start the next week, to start October. I'm going to be monitoring first of all around this 1870-75 zone. And if ever we get back down there and hold, that would be a nice indication that we are building some kind of a bottom in silver again. If not, if the dollar comes back, then we might be looking again at mid 18s or even back to low 18s. If we start to break above this 1930, 1950, then I might be putting out a statement that the decline is done and that we are going to start to get back higher. And I don't know about Stel, if you have anything to add to the silver for the silver bugs amongst us.
No, I agree with what you said. I am personally waiting to see if gold is going to break up above 1690. I've said that for a while now. That's, for me, it's a huge bull bear line. Any daily or weekly close above 1690 is turning the metals bullish for me. So that's where I'm going to start getting some gold and silver, I think, as well. But I'm not 100% convinced yet, because we're not there, and we're still languishing in gold below that level. And silver, yes, it's looking constructive, but still not a breakout by any means. So I'm being patient, and this can move quite a bit over weeks and months. So yeah. I'm not in a hurry. As I've said so many times, I don't mind if I miss the first part of a move, as long as I pick up a nice chunk of the meat of it, basically.
And actually, that's very interesting you're saying that, because it's got a lot to do with trading and psychology, especially if we look at fundamentals, if we look at more medium-term trades. I mean, for those who are doing day trading and you're in the market and you trade like a high-frequency trading platform, yes, you are going to pick bottoms and tops. But for those who are in it for more the medium term, it depends on the positions. I'm anywhere in between a day trader and a long-term trader. But silver, I'm still holding my long-term, and I'm looking to add as well. But then I'm trading the stuff around more often with my add-ons. But in any trading, what you do, I mean, don't worry if you don't get the bottoms and the tops. For if you're in it for more medium term, it's actually better to get the confirmation that we see a bottom and then we start to move higher again and we start to build a trend. And it's not like I mean, trading is not a pure science where one plus one equals two. It's anything else but two. But in rough terms, if you are a long-term trader and you miss the first third of the move, it's nothing to worry about, as long as you have the other 2/3. And even the other 2/3, there's going to be a quarter at the top where you're going to sell it out too early compared to what the market is doing. But as Stellers was saying, it doesn't really matter, for as long as you take the trend and the chunk of the trend. Right, Stel?
It's also, yeah, and it's also a lot less stressful to not be trying to pick both tops and bottoms. So,
yeah, absolutely.
But then again, it just depends on your personal style. This is what I like doing. It doesn't mean it's what you like doing, you know?
Yeah, absolutely. I mean, there's not, because people often ask when they start trading, so how do you trade? And I want to mimic this and I want to mimic that. Don't. Find your own trading style. Really find your own trading style. By doing an error, you will find it. If it's pure text, it's okay. If it's pure fundamentals, it's okay. It's very okay, even. And if it's a bit of both, it's if you master both, then it's the best of both worlds. But you have to find your own way in these markets, your own trading style, really. Whether it's on well, I couldn't do the minutes or 5 minutes charts, but it all depends on what you feel in the end the most comfortable with. But do spend some time to find your own trading style. Then we are going to have a look. We have to have a little look at the pound, right? The pound. We've gone today. We've gone above this 112 line we had. It's well, a lot of it has to do, of course, with Quartain Trust, Bank of England, and everything. But it's a decent level, this 112, in my opinion. It's a correction levels of those declines, whether short, more medium. A lot is happening around 112, with a stretch up to 113, I'd say. But well, my opinion is that it's going to be difficult to hold, not only for the sterling side, but also for the dollar side. Yes, we are moving away from the 4% in the 10-year, which everybody's watching and people are talking about, and even longer term hedge fund traders saying that they did stuff around 4% buying bonds and everything. But we can't forget that next month we still have quantitative tightening in the States. We're still not falling out of bed in the data in the US, and the Fed is still going to hike. So I'm going to be very, very interested going into the next week. And if we see the last ramp higher into today's fixings, I may be getting very tempted to in this one. Another one on the euro sterling. We've had this little channel that we built from August. We've broken out of it violently. This one has come to longer term. the 95 back down to 82 move. The 78.6 was around 92.25. We went there. I don't know whether the highs are real or not, but anyway, I mean, some people actually caught that in our room, which is absolutely super. But we really collapsed from it, and now we are back trading in this channel. We are actually trying to move out of it on the downside right now, but a lot is fixings, and I'm not sure that the sterling will be able to keep its strength. So anyway, I'm going to be interested to see what's happening post the fixings here in euro sterling. At the end of the day, it might be ripe for a bit of a catch the knife, perhaps, unless we start to break below 87, of course. So that for the euro sterling. Then euro dollar. The euro dollar, we run resistance. Well, we tagged it this morning around this 98.40s. We were talking about this in the room. There's more waiting in the 98.60s and all the way up to 99, in my opinion. Whether it's going to hold, we have to wait to see what happens with those later on fixings today. It's a real mess. Banks don't know. Well, I mean, they all seem to know, but they have been telling one side and the opposite. We can't really know what's going to go happen this afternoon, to be honest. For those trading takes, if we get back under 97.90, perhaps it's already a bit of a rejection there as well. What else? EuroCAD. Okay, EuroCAD. This is end of month stuff, really. We've even flew through this mega 134 level where we had the breakdown and never since even revisited close. And then over the end of month now, we really see this spike. Oils, they dipped before, which could explain part of it, but then the last bit of it, I think, is pure end of month trading. I'm just a very, very tiny bit in there, and I'm watching for the end of the day. If we get a rejection here, I think it's going to be a pretty good sign. Just hold on one sec. So that's for the euro CAD. Dollar NOKI, euro NOKI. First of all, I think we're hanging around this June top, but Norges Bank just came out with their Norwegian kroner sales for the month of October, and they are upping those sales. So even doing more, they're going to sell 4.3 billion Norwegian kroner every day in the month of October. Unless oil and gas really flies again, I reckon Norwegian kroner may stay on the defensive. There are going to be buyers of Norwegian kroner to offset this because they have to pay for their taxes, but I'm not 100% sure when that is to happen. I know something happening around the turn of this month, so we may see a little bit of a relief in the Norwegian kroner. But I think if we get down to levels of 10.30, unless I say gas and oil flies, I think this could hold for now. Dollar Norway is a mess. I'm not even going to. Well, okay. Well, let's have a look at it quickly. Yeah, here as well, we've broken through this around 10.65. We're back on it right now. It could already be enough, 10.60, 65. We traded on it, and now we're back higher. That's another one I'm going to keep an eye on. It could be getting another leg. I'm just saying it could because I still think that the dollar isn't done for various reasons. Okay, then, and people were asking about stocks. I'm just going to cover the S&P 500, and then Ryan will have the utmost pleasure to cover the rest. I think
Thanks,
we're in
mate.
a bit of a we're in a bit of a range here between trend lines, and on some and on a couple of pips, 36, 3600, 35, 35.95 around there, stretch it to 35.75. If that goes, it's really bad news for the S&P, in my opinion. But again, I will not make a decision before the end of month is finished, and as we go into start the next month. Top side, we've held this resistance line here now, which broken before. We had a retest, and that was around 37.30s. Now it's coming down a little bit. It's around 37.25. So I think that is the level to watch, a first level to watch on the top side. If that would go, if the dollar would start to weaken, etc., blah blah blah. If the rates are starting to, the yields are starting to pull off more, and then this could get a move back into 38. Why not even 38.5? If ever we're starting to fly, I think 39 is going to be a big level of fighting again for what's going to happen, because it's been really jumpy around there, and I expect if ever we get back up there, that this is going to be a big level again on 39. And with that, my friend Ryan, go ahead.
Thank you very much. I think oh no, Stel's gone. Where's Stel gone? He's opted out. I was going to ask him to do the Brazilian Bovespa analysis, but he's run out the door. He knew it was coming. He's he's gone.
Stella and Steve, when something a little bit more difficult comes up, they just run.
They just run. Scaredy cats. I'll get them. Don't worry. We'll catch up to them, folks. Right. Right. There's one thing I want to talk about quickly, because it's very important what Cansdale was saying about the type of trader you are, and it's probably something we should do as a subject on a show one day, when the world's not burning around us as it has been this week. It is important to get yourself in the right trading mood, if you like, and find your own way and your own strategies, and that's the best way to do it. And I think for some of you traders who are maybe part-time or shorter time traders, probably longer term trading and looking at wider charts is probably more beneficial for you than trying to get in the short-term moves where you're not seeing everything and the whole picture day to day. It requires a bit more patience, but it also takes you out the everyday noise. But as I say, that's something I'll note down for we'll do a whole show on that one day. But one thing I want to touch on today is my big take from this week, is that I've had a real big reminder that the market is far bigger than I am, far bigger than we all are. I've had two trades that have gone pretty badly, spectacularly badly in terms of pip moves. One being this dollar yen, which I'll put up on the dollar yuan, which I'll put up on the chart again. Now I was shorted into this zone up here, 114s, 50s. I started all the way through this zone because I thought it was going to be a real strong technical area, or on the text it was shown as a big strong technical area. You know, looking at that here, it was more a technical trade than anything else. Now you look at it where the price is today, and that would have been a great trade if we hadn't had the blowout, but we did have the blowout. That's what happens in markets. You can have the best laid plans, and the market will show you that it can do you more than you can do it, in terms of how it can move. The same with cable. You know, I was buying Friday evening when we were down 108s, 109s. I thought I'd run a buys down into 105s, this big area here. Wallet got knocked out on that move. And then what's happened since? Well, it's done exactly what I thought it might do on the Friday. There's two ways you deal with that. Obviously, you can't do anything about it. That's what happens in trading. All you can do is set your risk by it. Now, as I mentioned previously, I wasn't going big risk on these trades. This move happening overnight, Sunday, early Monday morning, did me a favor, because I didn't have the rest of my bids laid in. I was working it manually, so I didn't have as much risk on the table as I would had I been able to buy it all the way down in a slow and steady manner. On the $1 side, yeah, I was fielding my offers all the way up. So I got stopped out, but again, my risk was defined from the start. I knew how much I would be losing if it all went wrong. Fortunately, managed to get in a trade yesterday on those headlines, and I've got a good chunk of that back. But that's what you've got to learn when you're trading. Okay, you can have the best ideas, the best technical setups, the best strategies, and still the market will take you to the cleaners. And all you can do about that, and I won't stop banging on about it, is make sure you have your risk protected. When you go into a trade, if you know your maximum loss and you're accepting that maximum loss, there's no shock. It doesn't matter what the market does. You know you can walk away with your account intact. Okay, you've taken a hit, but you come back the next day, you get on with the next trades, and you carry on as you were before. And it's very important to know that when you're trading. But anyway, looking at, let's just look at a couple of things. A couple of trades I'm in. I'm still short this one from yesterday, those moves there. We are finding a little bit of traffic in this 06, 07 zone down towards this fib area for $1. Going to see where it goes. If we get back above this bounce high here around about the 113s or 713s, it may see us move a bit high. If we get above this 14-15 area, then maybe we're going to go back and test up to this zone again up here. Conversely, a move under this area here probably is going to target these lows and these previous highs around 104s, 105, 04s, 05s, 06s, and this fib here. If we break under there, we're heading down towards the 7 area, and we'll see what happens down there. Now, dollar yen. Who'd have thought it, eh? The one pair that was going bananas before last week is probably the quietest pair of the week, doing nothing at the moment, but staying below that 145 area, which is proving to be a key level at the moment. We're finding support on and off in this 20 zone, 144.20s, then down towards the 144s. So it's certainly not out the woods in terms of the overall trend. Of that we should be in no doubt, but we have got a bit of a pause. Let's look at that. So, you know, this trend isn't for breaking yet, and this is just a trend since August. So there's no real signs when you look at a longer term chart that we're going to be heading meaningfully lower or that we found a top. The only indications that we are perhaps topping is now we're seeing a series of resistance into that 145 area. But looking at this basis, we're getting higher lows. So keep an eye on that. We've warned all through this week. The BOJ, MOF, they haven't got a price target. The market might be putting a price target on it in saying they're defending 145. There may be a good weight of money trading on that basis, hence why 145 is becoming solid resistance. But if they're not really there, then if it does blow through, we could see another quick pop up towards the recent highs up there. Gold is probably one other one I will look at that I'm keeping a beady eye on. We've had it. Oh, let's zoom it in a little bit. We've had a bit more of a creep up towards this 75, probably call it 75, 80, 85, 86, whatever you want to put your number on it. It's a big old zone up here, $10 zone. We've had a little move up towards it, 74s. It's showing up as resistance again. We've had it knocked down once again. This is probably going to be a really key area up here, this zone. If we get above that and hold above that, then we're probably heading back up to 1700 and maybe higher. If we find that we're banging our head on this one, then potentially we're going to get another move to the downside. As we've been highlighting, as I've been showing this week, this 1641.40 level is becoming a bit pivotal for the gold there, in my opinion. Just looking at some of your questions now. Arif, thanks for the daily webinars. They're great. Thank you very much, sir. My mate is back off his head at Schroders London. He told me last night all order flow is out of government into corp bonds. I'm not sure about how much of that is happening. Possibly because obviously I wouldn't say the government, probably at the BOE in their operations. If you're in the chat room and go into our Flyonomics room, we've got a couple of guys in there who have been talking to their contacts in banks and have a better idea of what's going on there. Long and short, one of them saying that it's really BlackRock's fault. They got themselves out of depth on what they're doing, and that they're really largely to blame for a big chunk of this. But yeah, thanks for the heads up there, Arif. All information is greatly received. And do you think a sovereign debt crisis is starting soon? When is it never going to start soon? There's always a sovereign debt crisis on the cards. You know, you can never rule out anything. We've been through so much over the last 2 decades, 15 years. You know, the Lehman's blowout, the MBS problem in the US, then the banking crisis, then COVID, then the war. You know, we just seem to be in a period of time where we're always close to the shit hitting the fan. Are we there yet? Right now, I don't think we are. We will do if rates are going to have to go even increasingly higher and inflation goes increasingly higher. If these 10% inflation levels are here to stay for a long while, and rates are going to be getting up 4, 5, 6, 7%, there's going to be a lot of pressure because, you know, everyone who's been, you know, taking debt, putting on debt, and I'm talking sovereigns at low rates, and now being crunched on the higher interest rates. Debt burdens are going to be ballooning. But if the EU and ECB and Eurozone are to be believed, they've got the tools to cope with it because that's what they spent the last 15 years developing, or at least the last 10 years developing since the banking crisis and the Eurozone crisis. So in theory, we should all be safe and sound. But are we there yet? No. But does it take much to get us there? Not at all. But I think we'll have plenty of time to see when that's coming. Anyway, it's nearly been an hour already. So as always, I want to thank you all very much for coming to the Flow Show. Been a very eventful week, a very eventful month, as Kay had rightly been banging on about in the last weeks of the summer. You know, I think it probably surpassed all our imaginations on how busy this one was, Kay?
Yeah, when I say end of August, I was saying like, be careful, QTs ramping up, be careful of this. September is always an active month, but even I must say that it's been some month. It's been wild at times. But hey, yeah. As long as we survive, and I hope everybody listening to us survived as well. We are trying to be helpful. Please, guys. Coming to our ForexAnalytix community, it's absolutely great. Make the publicity about it as well, because a lot of people are just helping each other out. We are not there to tell people how great we are. We are there, and the people, and the people there as well. We really just help each other out, trying not to be part of the brokers' statement saying that 76% of their traders or of their accounts are losing money. We are just trying to help everybody to be part of those 24%, you know, and I say with some success. So join us, and thanks everybody for coming around here as well. I hope you have a great end of month and a stellar weekend.
Yeah, well said, mate. You know, consider us if you get weeks like this in markets where you want to find a bomb shelter to go and hide in, then something like the ForexAnalytix chat room is the perfect place to come and hide out in, because we'll keep your feet on the ground and get you through the volatility. And on that note, as I say, thank you very much all for coming to the Flow Show. I'm going to be disappearing out now to do my bit for UK retail sales and GDP, because I'm off to buy myself a car. So if I can manage to do that successfully without something going wrong on the way, touch wood. Have a great weekend all. The UK is going to survive until Monday, I think. So we will have a Flow Show for you on Monday. Until then, have a good one. Thank you very much.